Welcome back to the Supply and Demand Pro Trader series. It's a series where I teach you how to master supply and demand so quickly you're probably going to apply it right now. So this is lesson 3. Today we are diving into the first rules of our process-based supply and demand trading strategy. Get ready as we explore the black and white process of identifying supply and demand zones. First, we define a zone, then we'll dive into the formations that represent supply and demand, followed by step-by-step instructions on how to locate these zones. Finally, it's time to put theory into action and apply what we have learned in this lesson. Exciting stuff. So let's jump right in.
Okay, let's jump into the first step of the process. Supply and demand zones are turning points. And what's going to happen with these supply and demand zones is that it's going to be an area on the chart where prices are most likely to change direction. This is where we find the imbalance of supply and demand. There are two types of zones. There's going to be a supply zone and there's going to be a demand zone. And those are going to be dictating where we should be buying or selling. So when we look at these zones, there are two distinct lines that we are going to be drawing, the proximal and the distal line. Our proximal line is always going to be the closest to whatever the current price is. So if we are looking at the demand zone, we are going to be looking at the proximal line being closest to the current price and the distal line being below it. The area between the proximal and the distal line we highlight with our yellow box that represents the imbalance. We are looking at an area where prices are likely to stop moving down and start rising. Consequently, in this area we want to buy. The proximal for supply is going to be the closest to current price as well. It would be the bottom line and the distal line on the top of the supply zone. The area between the proximal and distal line we highlight with our yellow box that represents the imbalance. We are looking at an area where prices are likely to stop moving up and start dropping. Consequently, in this area we want to sell to enter, or in other words, to go short. Okay, let's look at one of the pictures that represents supply and demand. A zone or level always consists of 3 parts, leg in, base, and leg out. To the left, we see a demand zone. You have first a drop in price, that is our leg in, then some basing, that is our base, and suddenly you get a strong move out to the upside from that area, which is our leg out. Now, the base in this area represents your imbalance, the area where demand exceeded supply and where we can find unfilled buy orders. This picture of demand we call drop, base, rally. Visually, it looks like an U shape. To the right, we have a picture that represents supply. First, we get a rally in price, that is your leg in. Then some basing, that is your base, and suddenly you get a strong move out to the downside from that area, which is your leg out. Now the base in this area represents your imbalance, the area where supply exceeded demand and where we can find unfilled sell orders. This picture of supply we call rally, base, drop, and visually it looks like an inverted U shape. All right, perfect. I also want to talk about the line placement for our demand zones or supply zones. I have to have rules. The more rule-based my trading is, the less emotions are going to be involved when I'm putting my money on the line. In this case, what I'm going to be looking for is to draw my lines. I have 2 lines. The proximal line will be drawn across the top of the bodies of the basing candles. The distal line is going to be drawn below the low, or in this case, I use the wicks, because they happen to be low, but if there were no wicks, I would just use the bottom of the bodies of the candles. So whatever the lowest low is, that's what I'm going to be drawing for my distal line in my area of demand. So once again, for the supply zones, we'll draw our proximal and distal lines just as we did with demand. Once again, we are going to draw that across the top of the wick or the high for the basing candles. The lower line is going to be the proximal line, and that will be drawn across the bodies of the basing candles before the selling pressure became very strong. This is where there was an imbalance of lots of supply versus demand. So it pushed prices downward very quickly. That's how we are going to be drawing the lines. All right. Now, when we are looking for zones, it's really just a 3-step process that we are going to be using in order to be able to find our trading opportunities. So we will see what this is. In order to identify demand zone, one of the key things we are going to be looking for, we start off always at the hard right edge. We are going to start off at our current price on our chart. Now, from that current price, we're going to look left and down until we find the origin of a strong rallying price. Very important, here you have to go along the candles without cutting through them. What we need to see are strong, explosive rallies, not just one green candle. We do have that, as a matter of fact, right in here in this area. And you may be saying, why isn't this an area of demand? We had this downward movement, it paused, and it started moving up. And one of the first things I would recommend is that you look at the size of the leg out. Why? The size of the leg out is one of the institutional footprints that we call zone qualifiers. We have many of those zone qualifiers, and I want to introduce to you one of them in this course. The size of the leg out tells me a lot about how strong price might be in a particular area. Right here, we can see that we have only one green candle that's starting off the bullish move. And we already pause. That's not what I want to see for a demand zone. So one of the zone qualifiers that we use in order to identify the proper area of demand is going to be how we departure the level. We want to leave the levels with large green candles. The larger the candles, the bigger the imbalance. Because think about it. Can we cause price to rally up like this? Of course not. This can only be caused by institutions. So when we are looking at this, we are going to be looking primarily for what we see here, the origin of an overall move and large candles leaving that area, kicking off that momentum. So once I found that demand zone, what will I then do is draw out my proximal and distal line and extend them forward. This is going to give me the area where I will buy, go long, should price return to that area of demand. So, when I identify supply, it's going to be very similar. We are going to start off at current price, but instead of looking left and down, we are going to look left and up for the origin of a move. You may say, well, Bernd, why didn't you just focus on this area? We had a nice little drop right here. Same concept as before. We want to see clear evidence of institutional activity. The leg out has to be explosive, strong, ideally multiple candles. Consequently, that's not the origin of the overall move. The origin of the move is way up here. And again, same procedure. So once I found that supply zone, what I will then do is draw out my proximal distal lines and extend them forward. This is going to give me the area where I will sell to enter, go short, should price return to that area of supply. Let's put into practice what we just learned. The basic steps to identify demand zone. This is oil futures, 240-minute chart, weekly income. Let's start with the process. What do you have to do first? Identify current price, correct. That's here. Next step, go down and left without cutting through candles. Very important. Don't cut the candles. Look for drop-based rally for the origin of a strong move. Once you identified the demand zone, draw the proximal and distal line and move them forward. When price comes down here, what do you want to do? Buy, right? Now, you're ready to place your set. Entry at the proximal line, stop loss below the distal line, and your target. Well, we haven't discussed the rules for target yet. Doesn't matter. That would be something for the entire Blueprint course. But it's important that you get the process. So now, once you placed your set, you can switch off your computer, laptop, and get alive.
Now, let's talk about something interesting. How much does a gallon of gas cost where you live? Well, I live in Dubai, and let's say, well, I don't even know the exact price, but it's around $3 per gallon. And imagine you also live in Dubai, so it's also $3 per gallon for you. But here's the kicker. What if I told you that just down the street there's a gas station selling gas for only 50 cents per gallon? Sounds crazy, right? Well, hold on to your seat because there's a catch. They only have a limited amount left and they are cutting it off after an hour. So what do? How do you feel about that? You rush to that gas station and load up on as much gas as you can, right? I mean, who wouldn't? It's an incredible opportunity. This isn't just a made-up story. This is real trading we are talking about. Look at this chart. It's live and it happened in our sessions. Can you believe it? Now think about it. What market are we looking at here? It's oil. We turn oil into gas, right? And guess what? It's on sale right here in the demand zone. But you know what most novice traders do? They sell when it's down here. Can you believe it? But you, my friend, you are different. You understand the game. You know that buying oil in the demand zone is like getting a huge discount on fuel for your car. It's a no-brainer, right? Let's dive into another example really quick. We're gonna explore the stock market and specifically focus on Uber. We'll be analyzing a 720-minute chart and discussing some weekly income strategies. Now, here's the exciting part. Regardless of asset class, market or securities you're interested in, the strategy remains the same. It's all about supply and demand. First things first, identify the current price. Keep an eye out for a significant drop in price where it is right now. We're talking a big plunge. Next, look for rally-based drop formations without cutting through candles. This is crucial once you have pinpointed the origin of the move. Once you've identified a supply zone, draw the proximal and distal lines. This is where things get really interesting. Get ready to set your positions and enter the game. Picture this. The price hits your supply zone like a bullseye. There's a massive imbalance and bam, it drops from there like nobody's business. And the rest, my friend, is history. I hope you found this lesson enjoyable and informative. Stay tuned for more exciting content. Happy and safe trading, folks.